Rich Lowe, Pilot Legacy, on site at the Stanton, Lockhart, Texas, with our January 2023 investor update. Recall that in our December 2022 update, we discussed the upcoming carve-out of the undeveloped 8 acres from Phase 1 into the parcels which would comprise Phase 2, the ground-up development of an additional 144 units. At the time of recording that update, which was December 1st, the surveying and replatting of the property were complete and the drawings and associated legal documents were under review by our lender, Arbor Realty Trust. The new survey and replat configured the Stanton property into 3 distinct parcels, B1, B2, and B3. Here you can see the entire property associated with Stanton Phase 1, the purchase of the existing 140 units as well as the 8 acres of undeveloped land toward the back of the property. We can refer to the Stanton property in its entirety as Lot 1. Approximately 6 acres, where the additional 144 units will be built, was replatted as shown and designated as Lot 1B2. The remaining 2 acres, situated adjacent to the railroad track and the regional joint detention pond, was separated from the residential plat and designated as Lot 1B3. B3 was separated from B2 because it contains an easement for public access to parkland and the joint detention pond itself. That portion of the original Stanton Phase 1 that's not included with lots B2 and B3 is now designated as Lot 1B1. Great, that's all well and good, except there was just one problem. Notice that the newly platted B2 possesses the only access point to Windsor Boulevard. This has the legal effect of isolating B1 from any access to Windsor Boulevard whatsoever, as both the first and second entrances into B1 must be made through B2. Practically speaking, this is not a big deal, right? However, with one point of entry into 2 residential plats and 2 distinct ownership entities, there was no way to avoid this. Well, the lender didn't like it. Why? With separate plats and separate deeds and titles forthcoming, legal access to one parcel via another just cannot be assumed, as you cannot guarantee the parcels, once subdivided, will remain in control of the same owner in the future. Well, by the time this issue was thoroughly discussed around the water cooler, the holiday season slowdown kicked in and the carve-out didn't execute in December like we had hoped. And as you all no doubt aware, things don't spin completely back up until about a week or so after New Year. So, since returning from the holidays, both Stewart Title and Arbor have agreed upon reciprocal easement language for lots B1 and B2, and the modification endorsement of the title policy for the Phase 1 loan and the subsequent Phase 2 carve-out is imminent. Seriously, the final details are being ironed out even as I stand here and speak to you. Now, this leads us to our next topic, debt service. Everyone was no doubt disappointed by the smaller than normal distribution from the Stanton last quarter. The Stanton Phase 1 loan on $19,550,000 is variable and predicated upon the 1-month London interbank offered rate with a 3.35% spread above that benchmark. Now, back in November of 2021, LIBOR was at 0.09, giving us a 3.44% rate on the loan. This gave us a monthly debt service of $56,000 on the Stanton. In the spring of 2022, interest rates began their climb and reached their highest level in 15 years this past December. As of today, LIBOR is at 4.55, pushing our interest rate up to 7.9. This has driven our monthly debt service for the Stanton up to $128,000, more than doubling what we paid a little over a year ago. Now, just this morning, the month-over-month change in the personal consumption expenditures price index came in at 5% even, moving favorably from 5.5% last month and 6.1% the month before. So it does appear the interest rate hikes are serving to cool inflation. However, it's well assumed that another 25 basis points is baked into the cake for next week's Fed meeting. Consequently, LIBOR is forecast to continue upward as well. Taking a look at the forward-looking LIBOR curve, we can see that LIBOR is forecast to peak this summer at approximately 5%. This would give us an 8.35% rate on the loan, or $136,000 per month debt service on the Stanton. Additionally, Arbor just notified us they will be converting from LIBOR to the Secured Overnight Financing Rate, or SOFR, as their new benchmark index this summer. That's largely inconsequential, and although projected to be slightly lower than LIBOR, the forward-looking SOFR curve, like LIBOR, is not forecast to bottom out in the near term until the spring of 2026, and then only to about 2.71%. This would bring our loan percentage to 6.06, or about $99,000 per month in debt service, as the lowest we could likely achieve in the near term. This isn't going to cut it, so here's the plan. Upon completion of the Phase 2 carve-out, we will be performing a cash-in refinancing of the Phase 1 property. With $1.375 million being paid to Phase 1 from Phase 2 for the purchase of the back 8 acres behind me, Arbor will refinance about $15.8 million of Phase 1 debt at a fixed rate of 1.7% above the 10-year Treasury. Here you can see the immediate benefit of moving to a fixed rate on the 10-year note. This takes us to about 5.1% immediately, and possibly lower depending on which day we lock in, taking 3% off our current variable interest rate and bringing us back into a monthly debt service of $67,000 with the new fixed rate. This is much closer to where we began in November of 2021, and certainly better than $136,000 per month we would be paying by this summer. The cash-in refi is a sensible course of action, as it does appear interest rates won't be headed back down until the summer, and then at a very slow rate over the following years. The fixed rate refi brings our cash flow back to where it needs to be now and takes the uncertainty of possible higher rates predicted in the near term off the table. So we have a plan to bring cash flow back to healthy levels to a property that's performing extraordinarily well. We're at 97% occupancy currently, and rental rates are right in line with market rates for A-class product in the Austin area. Yes, partially due to inflation, but also due to strong continuing demand in the Austin MSA at large. However, we are going to have to bring in additional equity to get Phase 2 across the finish line. Why? Since purchasing Phase 1, we have had our loan proceeds cut 3 times. Interest rates have doubled our debt service, and personal service as well as material costs have continued upward due to inflation and material scarcity caused by supply chain disruptions. All these factors have tremendously impacted our model as originally envisioned. But here's the good news. Phase 1 units were purchased for about $185,000 per unit, and Phase 2 is being built for $215,000 per unit. That's a combined basis of $200,000 per unit on a 284-unit A-class community. Newly built A-class properties in the Austin MSA are currently going for between $250,000 and $300,000 right now, currently. We're in great shape at the Stanton on an equity basis. You might say that we're asset rich and cash flow poor under our current debt configuration, but we are remedying that situation in the days ahead by taking on a lower fixed rate and eliminating the risk of interest rate unknowns in the near term. Now, on the topic of the additional equity raise, some investors have expressed concern that their ownership interest will be diluted as we continue to bring in equity. Keep in mind that although the Stanton comprises Phase 1 and Phase 2 components, it is one investment. It always has been. Did we think we had all the required capital in place 9 months ago? Yes, absolutely. Was the capital raise closed? No. The capital raise is never closed until the deal is closed. Every time interest rates go up, the lenders become more risk averse. Nothing is more damaging to your capital raise and financial model than a cut in loan proceeds. Expect much greater clarity on the precise capital requirements to close Phase 2 once the carve-out and cash-in refinancing of Phase 1 is complete. And the addition of extra capital can be accommodated by existing investors and new investors alike. Once we close on Phase 2, we will then know what the precise ownership interests across the project are. But until then, we are only paying on the preferred return, and where that preferred return is not being met, it is being accrued until our cash flow permits resumption of that accrued amount and any pref going forward. Finally, recall that when Berkadia marketed the Stanton in 2021, it was presented with a Phase 2 opportunity comprising only 48 additional units with on-site stormwater detention. However, due to the groundwork costs associated with on-site stormwater detention, estimated to be over $1 million for us alone, a 48-unit Phase 2 development was not financially feasible. Pilot Legacy undertook the initiative, negotiations, and planning to implement a regional joint use solution with neighboring developers, something that would greatly reduce the cost by spreading it across multiple users. Although extremely challenging, this course of action afforded a 144-unit Phase 2 versus only 48 units, bringing the highest and best use to the land and much greater value to investors. So by this time next month, we hope to have not only news of the completed carve-out and Phase 1 refinancing, but a closed Phase 2 construction loan and development underway. Nothing is more damage and material scarcity caused by supply with the new fixed rate.